Well, hello everyone. We want to thank you for spending some time with us on today's webinar, the FCN 401k Annual Plan Update webinar. We've got some people just joining us. Julie in Buffalo, Mike in Virginia, Bob, not sure where you're at, Ann in Maryland, and again, Kristen in Boulder. Thanks everybody for getting on the call this morning. A couple housekeeping things before we get started. We are going to record the call, so if you missed part of it or you're late, you can listen to this later, and Paul in the group and Sullivan will put that together and we'll send out a reminder. The other is that I think we'll open up the lines for questions towards the end of the webinar, and so if you have a question, just go ahead and write that down and send that, or when we open up the lines, you can talk. We do have a chat available. If you're on the webinar link, you can also enter your question into the chat portion of that, and we'll hang on to those again until later in the call. So again, we want to welcome everybody to the webinar. This is the FCN 401k Annual Plan Webinar Update. The first half of the webinar is going to be Paul Sullivan and the Sullivan Wealth Management team going over the 401k enrollment program. We've got, I think, on the phone with Paul Sullivan, Raj Goenka, maybe Ikesh Pandley, and then I know we have Ryan Beckett on the call. And again, they're going to be discussing the benefits of participating in the 401k, tax breaks, how to get started, eligibility, making changes, your different investment choices, getting enrolled, retirement withdrawals, and what to do with old or previous 401ks and IRAs. And also on the call, we have Troy Patton from Archer Investment Corporation. Troy's the portfolio manager, and Troy is going to give an overview of the current stock market, his opinions on where it's headed, and some recommendations on your 401k investment options. And so with that, I think we're ready to get started. Let me make sure we've got everybody muted so that we can hear the presenters. And Ryan, go ahead. I think it's all yours.
Thanks, Jeff. So we just wanted to start with going over what a 401k plan is, just a basic overview or review for anyone who kind of wanted a refresher. So a 401k plan is essentially a savings or an investment account for your retirement. So kind of the old days of when you would work for a company for 40 years and you'd get a pension at the end of that are really long gone. There's maybe a few government pensions, but private companies really aren't doing pensions at all anymore. So retirement's really kind of in your hands, and the 401k plan is really the best way to do it. Social Security is really never enough for people that we see to live on, and you really need to kind of put the retirement savings and retirement plan for yourself in your own hands. So FCN offers a 401k plan, and that's a great option. So as far as how it works, in general, you decide how much you're going to put in each pay period from your paycheck. You can do a percentage, you can do a dollar amount, which you can always change. If you wanted to go up or down, depending on what you have going on, you can always increase or decrease your amount. So you put in an amount of your pay, let's say 5% each paycheck, and that amount goes into your 401k account, and then you opt to typically invest it in some mix of stocks and bonds, which would grow over time, and then you eventually have it in retirement when you need it. FCN also offers an employer match, which is basically the company putting in money into your 401k account to match the money that you put in. So it's essentially a bonus that goes into your account, which is a great option, a great thing to take advantage of whenever a company offers it. As far as the amount you can put in, you can do anything from $0 up to $19,500 in 2021 this year. If you're 50 or older this year, you can put in another $6,500. And those are the maximum numbers. So again, you can do anything between 0 and those amounts. And that can always be changed. So, if something ever changes, you can always increase or decrease it. If you get a raise, you can increase it. If you need savings in other areas, you can always decrease it. So just important to keep that in mind. And then if you've been working at FCN for 3 months and you're 21 or over, you can enroll. So if there's anyone new that just started, once you hit that 3 months, you can join. So going to the next slide, one of the biggest advantages of contributing to the 401k account is the tax savings that come along with it. So every dollar you put into the 401k account is not taxed at the federal or state level. So just a rough example, let's say you have a salaried FCN of $50,000 and you decide to put in $10,000 of your own money into the 401k account. You're only taxed on $40,000 now, as if your salary was $40,000. The money you put in and then the money FCN puts into your 401k account, and then assuming you've invested that money in your 401k account, any investment gains and interest and dividends in that 401k account are not taxed until they're distributed. There is a Roth option that we can go over in detail, but in general, most people choose the traditional option, which is what that example would be. It's important to keep in mind that if you do withdraw the money or need to withdraw it before you're 59.5, you will pay a 10% penalty on the amount you take out, and then also you'd pay normal income tax just like you would salary on the amount. So, we in general always recommend put the money in, but if you're going to ever need it, you don't really want to put it in the 401k account. They want to make sure that you're keeping it for long-term retirement and are not pulling it out each year. So it's important to keep in mind that penalty amount. So another big benefit of the 401k account and contributing is the employer match. So FCN offers a generous employer match. So it's a little confusing, but in general, we always recommend people put in 7% of their own money to be able to get the full employer match of 5%. So as a rough example, if you put in 7% of your pay, each paycheck, FCN will put in 5% into your 401k account. Total of 12%, but you only put in 7%. FCN put in 5%. You can see the different examples. So if you put in 5%, FCN will only put in 4%. And then if you put in 3%, FCN will put in 3%. If you do 10% of your salary, FCN is only going to do 5%. So to get the maximum, we always recommend you do 7%. So as far as getting started in the 401k, if you're not enrolled, if you have questions or anything, the best person to start at is with Perlin. She'll help you get all set up with the payroll and get that all started, and then she'll put us in touch with, we'll get in touch with you from her. But she's the first person to start at if you're new and want to get the ball rolling. The 401k account, for anybody, it's always available online at Employee Fiduciary. The website's there. If you need help logging in or questions on the website or anything, feel free to always give us a call or email. On the website, you can check the balances. You can check contributions you put in, the company's put in. You can check what investments you're in. You can change the investments there on the website. You can check the returns, kind of see how you've been doing for the year, the past couple of years. You can check statements. So you can pretty much do everything on the website. So if you ever need to, that's where you go. So as far as what we're here to help you for, we're always available for a meeting as far as if you want a review of your account to kind of see how it's been doing, any suggestions we'd offer on, the investments in them or, anything else outside of that, we're happy to meet annually. If you're new, we're always here for a sign-up meeting to help you enroll in the plan. Any questions you have, kind of go over what your risk level might be as far as what you'd want to be invested in, and then make recommendations on the investments that are available in the plan and kind of what we'd recommend based on our discussion. And then we're always here for telephone calls, Zooms, emails. If you have any questions, we're always here. And then if anyone's ever interested, we do offer financial planning. In general, depending on what you're looking for, but in general, our financial planning process is we kind of look at what you own today, your assets. We look at your debts, mortgages, car loans, anything like that, and then we put together a current net worth of what you have. And then we kind of project out what's going to happen in the future year by year so you can kind of see based on your income and what else you have going on, where your asset level and where you're kind of going in the future. and then we make recommendations on how you can improve both your current and then moving forward your future financial situation. So that's always an option if anyone's ever interested. And just a reminder, we sent an investment review to everybody in the 401k account, so hopefully everyone got it. If they have questions or want to review their account, we're here. We're happy to meet, Zoom, telephone call, whatever works. I know everyone, I think, just got finished with the end of the fiscal year for you guys, so hopefully you've had some time to relax a little bit, and we're here if you're available and interested. So.
Ryan, the lines are open if anybody has any questions for Ryan or Paul there at Sullivan Wealth Management.
Yeah, if anyone has questions, it's a great time.
Yeah, good morning.
Morning, how you doing?
Yes, this is Sam Suma with FCN.
How you doing, Sam?
Yeah, boss. The question that I have, I think actually I have a 50% of my 401k in the investment side. I was wondering if there is a way to increase that, like 75%, and what's the risk with that, or something that I can do. That's what I would like to know.
I mean, your mix of investments you cover with us. Our job is to give you education on what that would do. You can change it in any manner you want, and the mechanics of that we handle. So all you'd have to do is call us, and then we would go over the different options, and it can be changed.
Okay. Okay.
And
so it's going to be like a kind of one-on-one, huh?
Correct. And our job is to tell you the education or points that you should consider and why it should be in one or the other.
Okay. I will call. Thank you.
Hey, Ryan, Troy, do you want to just briefly tell them about just high level about, picking investments? And I know you kind of covered it, but just kind of back to start saying, hey, you can always put, 50% in here, or you change it, and just how to make those changes.
Yeah, sure. No, so I think, whenever you start, I think it's always best if we can have a conversation just to kind of help you get on the right track as far as understanding what's available in the plan and kind of where you might fit investment-wise and what you might be interested in, just depending on your age and risk level and all that. We can help map out, and give our recommendation on that. As far as, if you ever did want to change investments, I think it's always good. We'd recommend at least annually to kind of review your account and see if where your investments are invested, if they're maybe too risky, maybe too conservative, just depending on your financial situation and kind of everything you have going on. So I think it's great at least once a year to kind of review that, risk level that you're taking and see if it's where you want to be. And again, we're always happy to help you see if, where you are is a good fit based on, what you're saying to us and stuff like that. But as far as changing the investments, you can always do it on the website yourself, or you can always give us a call, and we're happy to give you recommendations on what to choose.
Thanks, Ryan. Troy, I think we've got your slides up if you're ready to go.
Okay, I'm sorry, give me 2 seconds. I'm going to move around here real quick. Okay, can everybody hear me?
Yes.
Yes.
All right, do you hear any wind?
No.
Not yet.
Okay. I just want to make sure. So, all right, so thanks, everybody. This is Troy Patton. I was hustling around to the other side I'm traveling today, so I wanted to make sure I was kind of out of the wind area. Okay. Just a few things I want to touch base with everybody today, and there's kind of 3 themes. When we talk about the economy or the stock market, and those 3 things today that I think that are pretty important are, number 1, earnings, and number 2, the consumer, and number 3, inflation. And if you notice, I left kind of the political side out of it. And the reason I did that is because when we go through these slides, a lot of times, policy does dictate certain things in the market, but they're usually short-term gyrations, and the long-term effects of the market are really driven by just other parameters in the stock market. So, okay, so with the first slide, I just want to real briefly touch on the earnings of the stock market and what's called earnings per share. And earnings per share is, let's say if Johnson & Johnson made $2 per share, that means, and let's say they had a million shares of the stock and a lot of different people owned it, so it made $2 per share, and it traded at 20 times of earnings per share, the stock would trade at $40, okay? So that first slide, if you take a look at it, the earnings per share, going back to like 1990, you can see it was at 14.2 times, 2015, 2010, 17, and here we are at 2020, and it says, 19.7, and we're even higher today. And so a lot of people start thinking, oh my gosh, we're at 20.2. I mean, the market is way overvalued. A couple things to think about. Number one, it is higher. But number 2, interest rates are extremely low, and I don't care if they're rising up to 2% on a 10-year Treasury, which is the money that the government lends out or asks people to pay them and takes a loan on. Interest rates are very cheap. I mean, if you go back, even to 2000 or 2010 or 2008, 2009, they are extremely low, and probably going to stay low. And is what that's enabled companies to do is borrow more money and put more margins and profits to the bottom line. And that'll probably continue to stay that way because every country in the world is kind of a little bit of a race to the bottom. Everybody wants to have cheap money available to basically fund the government. Okay, so with that being said, I just want to kind of jump to the next slide if we can, Jeff, real quick here. I don't know if you see it. Got it up?
Current valuation. Yeah.
Yep. So the current valuation, you can see that the current valuation in the stock market has actually been dropping a little bit. And a lot of people think, oh, the stock market's been dropping. That's actually not the case. The stock market hasn't dropped as much. It's just that companies, the earnings per share are actually increasing. And if you think about it, if you go back over the last 4 quarters, a lot of those quarters were, in COVID. So, some of the earnings were down a little bit. And so the anticipation is that companies get back to more of a normalized operation at some point. We have, for instance, the new Merck drug that's coming out, the antiviral pill. I think that's huge news, frankly. And, as more people get antibodies, and, we kind of get to the point where there really is no such thing as herd immunity. I don't want to argue that point, but the vaccine is called a vaccine, but it's antibodies. You can still get COVID. It just helps you to fight it off better. So it's really not necessarily the same thing as a complete vaccine. But with that being said, I think that, companies like Merck and J&J and Moderna and all those companies are doing a really good job at getting all these drugs to market, which is going to get our companies and hopefully all of our citizens back to more normalized environment, unemployment going down, et cetera. Okay? And then on the next slide, you can see the one thing that we track every quarter is we want to know if earnings are going up or down. That's just simple as that. Are they going up or are they going down? Are more companies reporting higher than lower? And right now, this year in 2021, the pink bar is the bar that we're looking at here. And you can see in the last quarter, in fact, 3 quarters ago, it was huge as we rebounded. But we still keep reporting higher earnings on a month-over-month, quarter-over-quarter basis, compared quarterly to the previous year, et cetera. So there's a lot of positives, I mean, with that chart that shows that companies are really getting back to, frankly, making more money. And just kind of going to the next chart, and I know I'm kind of harping on the earnings of companies, but it's real. I mean, if you look at those three like light blue bars on the next slide, you're on slide 5, Jeff, I think?
Yes.
Okay, yeah. So those are the expected earnings of companies. And as you can see, I mean, companies are forecasting that they are going to be making a lot more money. And part of that, as all of you know, I mean, a lot of you got checks in the mail. The government is throwing literally trillions of dollars out into the economy, trillions. And I assume everybody's listening to the news, and they're talking about in Washington, you know, maybe another $3 trillion, and maybe it'll be $2 trillion. But the fact is, they did $5.5 trillion before, and it still isn't even all spent, and it won't be spent until 2023. So, I mean, the amount of money, pure money, in the system is massive. Now, there's pros to that, because that means people have the ability to buy and ability to spend money. The cons are inflation, and we'll talk about that here in a little bit. But I just want to go to the next slide, just real quick here. Let me know when you have that up, Jeff.
It's up.
Okay. So one of the things that has been driving the stock market much higher, and I'm looking at the box chart on the left, is it's like the dark green line, or it's kind of olive green line, is that's the earnings valuation of the top 10 companies in the S&P 500. So, you know, I'm talking about Amazon, okay, you know, companies like that. Companies, those companies' earnings and valuations, and when I say valuation, just like we were saying, 20 times 2 is 40. So those companies are much, much higher. In fact, those 10 companies are at 28.6. Okay, that's the current. That's as of, I think it's September 30th possibly, but that 28.6, and the remaining stocks are 19.1. So yes, our valuations may be stretched a bit, but a lot of it's in those top 10 companies. So if you own, for instance, the S&P 500 index, which is in the plan, which is a great fund to be in, just know that those companies may tend to be overvalued. And even though the S&P 500 may, if it drops 10%, it's likely that those bottom 490 companies, or maybe it'll be 400 companies, probably will not drop quite as much as some of the companies that are priced to what we call perfection. Okay? The next chart I want to show you, and I mean, this is an absolutely technical chart. I follow it pretty closely. I always want to know if the market's overvalued or undervalued. And the kind of the squiggly line that goes, there is just one line that goes through the middle. It's not a candlestick chart, but it's just one line that kind of stays in between the two lines for the most part. That tells me whether the market's overvalued or undervalued based on the money flow that's going into the market and into stocks. And right now, it appears that we are fairly valued. I'm not going to say that the market's not due for a correction, because frankly it is. Just so you know, over the last 100 years, we've probably had about 88 corrections that probably average somewhere between 15 and 20%. That's 88 of them over the last 100 years. So a lot of times when the market goes down, 6, 7, 8%, or even 10%, people panic and they say, oh, I need to go to cash. I mean, the market's going to collapse. Well, it's very likely that it may go down further, but the problem is trying to be right twice and then to get back in. So whether you're invested in the S&P 500 index or a multitude of different investments, I always say create an investment style, and Paul's team can help you do that reflects your risk tolerance. So if you own bonds, it's likely that those bonds don't go down similarly to stocks. So if you were 70% stocks and 30% bonds, you may go down, your account may go down only 70%, for instance, of what the stock market would. Okay? And conversely, if it goes up, it may only go up 70%. So there's some trade-offs. But if it helps you to sleep at night, then there's nothing wrong with that. Okay? Okay. The next slide, I just want to talk real quickly as we're talking about stocks, is growth versus value. And Paul's team has heard me say this for a long time. If you look over the years, I mean, decades of the stock market and over time, value has always been a good investment. It's more of a kind of a slow and steady wins the race type mentality. And we're talking about companies like Johnson & Johnson or Pfizer or some of the companies that are just, they're kind of boring, but they typically pay dividends, and the dividends are usually larger than the average dividend. And like I said, they're just kind of a little bit boring. Well, frankly, those boring stocks have actually underperformed because everybody's been chasing, again, like we said, those top 10 stocks in the stock market. If you think about it, like companies like Tesla and Amazon and NVIDIA and companies like that, people are piling into. There's not the, I like Amazon, I like NVIDIA, I like Tesla. And different funds, we own all of them, and a lot of you in your accounts own them. They're great companies. It's just, again, that's what people have been piling their money into. And, it's possible that there's a competitor to Amazon, maybe not. I mean, they're awful big at this point. But NVIDIA, Tesla, obviously a lot of people are coming online with electric cars. So there is some risk there. But that's what has driven the growth stocks much, much higher versus value. With that being said, value's done pretty well over the last year. As you can see, it's ticked back up a bit, but it's still vastly underperforming by about 35% to growth stocks. Okay? The next slide, Jeff, you got it up?
Yes.
Okay. The next slide is really just it really just discusses the change in the stock market, from the high to where we're at to the corrections that it has intra-year. And if you can look even back over time, you can see that there's quite a few corrections. I mean, the market dropping, 10%, 7%, 23%, et cetera. I mean, from its high, but a lot of times, if you look, the stock market actually ends up even though it's down. I mean, in fact, in one instance, there was an interim period where the market was down 28%, but it finished up 23%. So, I mean, I think that chart is really good to look at, and it's there to remind you that the stock market is resilient. And I say this all the time, but the United States is undefeated in comebacks, and the market keeps moving higher and higher. Okay? Over time, over periods of time, all right? Okay, the next slide is the consumer. And this is where it really gets interesting. If, on the left side, it says the total assets of the consumer are at about $159 trillion, okay? $159 trillion. Just to put that in perspective, the third quarter of 2007, before the market kind of fell apart, it was $85 trillion. So, I mean, we're nearly double the assets. The consumer has nearly double the assets. And in fact, right now, if you include corporations and consumers, there's over $73 trillion in the bank right now. $73 trillion. It's the largest amount by far, I think by nearly 30% more than we've ever had in any quarter. There is the velocity of money and the sheer amount of money and borrowing ability in the United States and even around the world is massive. The problem is we have a supply issue. I mean, you've all heard, there's shipping boats literally, anchored off the coasts because they can't even get in to bring in product that people want to buy. That's why there's vehicles literally sitting in yards, I mean, big, fields and yards waiting for chips. And it's caused used car prices to skyrocket. If anybody's traded in their car, you probably know that. Or if you sold a used car or even tried to go buy a new car, you probably know exactly what I'm talking about. So that's one of the things that, we need to take into account. And that is why a lot of people right now are very worried about the economy. And I would say this, I'm not worried about the economy. I'm worried about aspects of the economy and how they play out. And that one area that I'm worried about, which is the next slide, and it's just one, I literally just put one word on there, it's inflation. And if anybody has bought anything, they understand what I'm talking about. Inflation's real. It's running about 5 to 6%, and maybe a little bit higher than that on some goods and services. But it is real. I mean, whenever you have more dollars chasing less goods or services, the price is going to increase. And that is probably what I'm worried about the most. But I'm not worried about it from the standpoint of people that have investments in the stock market. And here's why. I always use this one example. And most of you own this company, it's Coca-Cola. Coca-Cola sells, let's say, 100 million cases of Coke every year, and it's actually more than that, 100 million cases of Coke. Let's say each can is 50 cents. Inflation is going to cause that can of Coke to go to 55 cents or 60 cents. The people at Coca-Cola are pretty smart. They know how to take into account what that value is of the can and the contents within it, and they increase their price appropriately. So, for instance, let's say they had margins of 10% previous, and now with inflation, they're going to keep it at 10%. What does that actually mean? It actually means that Coke makes more money, their earnings per share moves higher, and the stock moves higher as well. And thus, the individual consumer or the individual investor, they also make more money in their investments, retirement accounts, and stock accounts, etc. Okay? So I know that's a real basic interpretation of inflation, but I mean that's what it is. So there are now. Don't get me wrong. If inflation was running at 10%, 20%, and we had what's called hyperinflation, then I probably would be more worried because companies can't keep up with that cost aspect of their goods and services. But frankly, at 5 to 6%, most good companies are going to be able to do that pretty easily. Okay? All right. With that, Ryan, Paul, Jeff, questions? Oh, you know what? I'm sorry. I did send Jeff one more slide or one more bit of information. Can you put that up, Jeff?
Yeah,
Sorry about
it's
that.
up. It's up. It's split into 2 slides, but it's up, Troy.
Okay. The one thing I wanted to do is I just printed off the returns of the investments that are in the 401k for everyone, so they can go back and look at what the returns have been over the last 12 months, and then 5 years on average of the different investments that are available in the 401k. And I think I heard Ryan say that this was recorded too, and so it's available for everybody as well to look at. Does anybody have any questions?
Troy, can you hear me? This is Gil Van Shore.
Yeah, sure.
Can you explain market timing and why that is, why our 401k, every time we change money from one fund to another, we get this warning about market timing?
Okay. Well, market timing that's more of a compliance issue. The warning, from changing, from one investment to another. Basically, that's not us. That's the SEC and what's called FINRA. They just mutual funds are not meant to trade, to move in and out of, and so they're trying to basically forewarn you that that's considered market timing, and it's not a good idea. It's not in your best interest. Now, in all fairness, it's your money. If you want to do it, do it. I don't do it with my own investments. I really try to buy something I feel like that fits my needs, for the next 3, 5, or 10 years, and try to just hold on to it. But that's what market timing is.
Thanks.
You're welcome.
Does anybody else have any questions for Troy?
I'm sorry, what, Jeff?
The lines are open. If somebody has a question for Troy or Paul or Ryan at Sullivan Wealth Management, go ahead and ask it. Ryan, I don't see any other questions on the chat coming through, and I don't hear anybody else. Would you want to kind of wrap up at this point?
Employees that are participating.
Hi, Ryan or Paul.
Ryan?
Is there anything else that you guys would like to cover? I don't see any other questions coming through on the phone lines or on the chat.
Hey, Ryan, I think you're either on mute or you're not on mute. I mean, I can hear you.
Well, we just wanted to say that for FCN, we have participation of somewhere in the area of 75, 80%. So, I mean, that's a good indication of the benefits. So if anybody's not in it, they should be in it. We sent out this was stated before, but we sent out a investment review for every participant that's in it. That piece of paper that we sent is supposed to spark you to give us a call. So go over your accounts. Anything should be changed. Evaluate your level of contribution, how old you are, what you should be contributing, the performance of your mix of funds, what's available in the funds. It's meant to just be to jostle your memory on what. Frankly, we don't get enough calls. I'll just tell you. It's meant to get you where everybody. We're here to, and you pay us to provide that service. So we're here. You have that piece of paper, just call Ryan, and we'll cover your account with you and anything that we recommend you change. But we do get very good participation from FCN.
Yeah. That's good information, Paul. And this is Troy. One of the things, we always say, you do want to communicate and talk to everybody and let them know if there's anything that's changed. Conversely to that, they always say the best investor is Rip Van Winkle, who can, put money away and go look at it in 15 years. I mean, but that emotionally, that's tough to do also.
Well, Paul, Troy, thank you. Ryan, thank you. We want to thank everybody on the call.
Thank you.
If there's any other questions, please give Sullivan Wealth Management a call. The number there in Bethesda is 240-800-4300. And you can see on the website, there's two websites, esullivanwm.net and esullivan.net. So thanks again, everybody. If you have questions, again,
All right, thank you.
Contact them or send them an email off the website. Thanks again.